Hello and welcome back to Pay Down Debt Solutions. I'm Jen, and on this channel, we teach velocity banking. We teach you a better way of getting yourself out of the debts that you've incurred. You may be coming to us because you have a situation with your debt and you're trying to figure out the best way for you to overcome that. And that is exactly what we teach you guys here on this channel. So Dan and I were business owners. I was in corporate America, Dan was in corporate America, and we found ourselves in a boatload of debt as soon as we began to really get into our businesses. Okay, so we left corporate America, we started our own businesses, and then as a few years went by, we found ourselves in a lot of debt. So we are no different than all of you out there. We know exactly what it's like to feel strapped and stressed by debt, to feel, that gnawing at the pit of your stomach that something's just not right, and that discomfort and that dis-ease that comes with the debt, okay? So we understand it. And guess what? We got ourselves out using the very same method that I'm going to be teaching you today. Today, I have a student example for you, a scenario that is pretty incredible. And, I want to share this with you. And Dan and I share these with you every day that we can because we want you to understand that there is a better way. You need to kick the traditional banking system that you're in to the curb and learn a different way of doing your banking. And guess what, guys? You can do it with exactly the same tools that you have in your tool belt that are called credit cards and lines of credit. Okay, so we teach you how to get out of debt using these tools. All right, these amazing tools that can get you out of debt, and that's exactly how Dan and I did it. We did it with credit cards. We started out with credit cards and got ourselves out. Now, I want to go over this with you. Again, my name is Jen. My husband, Dan, we are business owners. I came from corporate America. Dan came from corporate America before we had our businesses, and I was a banker and a branch manager. So I speak to you coming from a totally different knowledge base, okay? So I understand these tools that the bank uses out there, and they use them against you in a lot of ways. But I'm going to teach you guys how to flip that on its head, and you guys learn to take over and control what the banks do instead of them controlling what you do, okay? So, one simple method and one simple tool has you debt free, okay? And again, those tools are lines of credit, what we call here RLOCs, which is a revolving line of credit. Now, in our student example today, we're going to be going over a home equity and how a home equity completely changed their situation, okay? But you guys can do this with credit cards, and you can do it with personal lines of credit, or you can do it with home equity lines of credit. But you need to learn a different way than the loans and lines you're taking on today and making the payment in the traditional way. And you find yourself in a lot of debt because you haven't learned how to run them differently. Okay, so that's what we're going to be going over today. Now, one banking tool can change your life. Okay, just one. I don't care if it's a credit card. I don't care if it's a personal line of credit, and I don't care if it's a home equity line of credit. But one of these tools can completely change your life if you learn how to use it properly. Now, my favorite debt instruments, okay, debt tools, debt weapons, debt destroyers, I like to call them, it would be the home equity line of credit. So if you have access to one or can get one, then that is my preferred method. Or even a personal line of credit works great too. And the reason being, you can put all of your income into these tools and run all of your expenses out, okay? A little bit differently than with the credit cards. With credit cards, you have to hold back any non-chargeables. With lines of credit, such as the home equity and the personal line of credit, most often you do not need to hold anything out because they are connected to your checking account, and they can be pulled, your funds can be pulled from that line of credit, no matter what it is, into the checking account to pay your bills, okay? So they are a little bit different, but they both work very, very well, which we have shown over and over and over again. So one tool, okay, just one, can change your life completely. We changed ours with one, and ours was a credit card, okay? And we see people do this every single day, you guys. So if you have any doubt, keep watching, keep going through the comments that you see under our YouTube channel, and you're going to see these. I will continue to bring you guys success stories. I will continue to read those emails to you because I think it's so important for you to see that you are not alone and that you can do this because there's other people just like you doing the exact same thing, all right? Okay, so choose lines over loans and you will find a way out through velocity banking. No more loans. From here on out, a loan is a 4-letter word, and I don't want you guys getting any more loans if you can avoid them. If you cannot avoid them, then you're going to work down those loans using a line of credit, which is what I'm going to show you guys here today on my board. Now, the debt trap is just ignorance, right? So, in this situation, in my student situation, the debt trap was ignorance. Now, ignorance only means unlearned, right? So there is no other negative connotation that you need to associate with the word ignorance, because ignorant just means unlearned about something. This woman here, okay, it's a family, but this woman here who has started in this debt, all right, she is highly educated, but she was ignorant to certain things as far as banking was concerned. And as smart as she is, and she is a pretty smart cookie, let me tell you, as smart as she is, she didn't know what she didn't know, just like you guys don't know what you don't know. So that is my job. My job today is to teach it to you. And I want to show you what a difference a line of credit can make in your life if you learn it. Okay. All right. So again, so the debt trap is just ignorance. It's just not knowing something. All right. So let's take a look at this scenario. I don't want to take up too much more time. I want this to be a quick video for you to see the success this couple had. Okay. Now, this student scenario is from American Express to American Distressed, is what I call it, because they are using an American Express card, and that American Express card can be a trap if you don't know how to run them. Okay. American Express can have two different payment buckets. Okay. One is the typical way that an American Express card works is that it's a line of credit that you pay in full every month. Okay. You have to pay it in full every month. If you do not, they have what we call a payment bucket, and they assign a certain dollar amount to that payment bucket that they will allow you to pay over time. Okay, so it's a pay over time bucket. Now, this can become a trap for you if you have, certain situations. And in their situation, it was kind of a trap for them. Okay. So they had some other expenses, believe it or not, that they were paying every month that caused them to not be able to get out of this card. So their payment every month was incredibly high. Okay. As you can see, it's $8,300 a month because they kept having to use that card to pay for other things that they were trying to pay down, okay, that they couldn't pay any other way. And I don't have those on the board because they're pretty much through those expenses now, but they're still, no matter how you look at it, they are still negative, okay? And they are negative $382 even, after clearing most of that up, okay? So they have a lot going on. So what we have is an income of $17,200. Now, I'm going to pause right there for a second, and we're going to discuss this because a lot of people would look at an income like that and be like, how on earth can they be in a financial situation that they're negative? Well, guess what, you guys? It doesn't matter what you make. It doesn't matter what you make. We all find ourselves in situations like this, okay? It's all relative to your life and your lifestyle. Here she is, a highly educated woman, making a ton of money, good for her. And not only that, but she found herself with student loan debts, right? Because student loan debt can be a killer. And some of the student loan debt here isn't even listed, okay? It's not being paid on at the moment, but I'm going to show you how she'll be able to handle those no problem coming up, okay? But so highly educated people, they are going to be paid a lot for sure. But you know what? They find themselves in a lot of debt, just like people that are of average income or even below income. And you know what, you guys, I've seen a lot of people below income making, their money work for them much better than people with a lot higher income. Okay. It's all in your situation and what you learn about banking and how you bank. So we are teaching you how to bank and how to think, how to change that mindset and do things different. Okay. So sorry, I know, tangent, right? I took off there on a tangent. Anyway, so cash flow is negative 382 because our income is 17,200. Our total expenses is 17,582. All right, which means we're negative. All right. Now, I wanted to list this a little bit different way for you because there is a lot going on. And a lot of you have a household like this where you have a lot going on. So I wanted to show you in a little different method here. I want to list out the living expenses so you can see them. I don't always do that, but today I decided I'd go ahead and show you what things look like, right? So living expenses, We've got gas for 30 bucks, okay, a month, which seems awfully low, but I don't know, maybe that's accurate. She says it is, I believe her, okay? So we've got internet 95. Now, again, if you guys are working from home, I guess it probably could be accurate, right? All right, internet 95, dog insurance, okay? So I'm guessing that's a health insurance, 63 bucks a month. Phone 179 a month. Spotify 21, groomer 66. They got a chiropractor 100 bucks a month, groceries 1600, eating out expense at 800. So this category for living expenses is 2,954, all right? And we couldn't fit them all in, so we moved some over. We've got utilities 400, we've got Netflix 20 bucks, car insurance 207. I'm listing my mortgage here right now, you guys, because we're not taking care of the mortgage in this. So I wanted to show you it in here. We've got 1,280, and then we've got beyond. Now, they were in a situation, or she was in a situation where she was trying to work through some of her debts that she had. So she did end up in a debt repayment plan of some sort, okay? And so she is paying monthly on that. So this is a good example on why I tell you guys, do not enter these debt repayment plans if you can avoid it, because you will continue to pay on this no matter what. She's still, she has consolidated some of this debt and using a company like that is charging her 25%. Okay, they're charging her on top of it. They're negotiating debts, but they're taking their piece, right? And okay, and she's still paying on it. It didn't alleviate the situation completely now, did it? Because she's still paying a hefty amount monthly to get those taken care of. Now, there is a better way. There is another way. And again, if you're ignorant about those ways, again, just meaning unlearned, this is why you watch channels like this, to learn how to handle debts differently, okay? So she's got this going on, all right? So this category here ends up at 3,971, okay? So now our total for our living expenses right now is 6,925 if you add these together, okay? So we're going to park that for a second. So then we're going to look at our loan debts, okay? So we're going to look at our debts here. Loan debts. So she's got a Sally Mae. This is a student loan that she is currently in a payback period, okay? So she has to pay back on this right now. So that is 926, and I didn't calculate in there the interest and all of that. That's something, again, we're going to look at taking care of that later. So she's got the American Express card. I talked to you guys about that. Be careful of that pay over time bucket. It is a killer because you have to pay, all right, everything above your minimum payment. If you are in that pay over time bucket and you owe more than that, you have to pay the balance. So if in her case, let's say it's 25,000, okay, her pay over time bucket is 25,000. So the 25, between the 25 and the 32, she has to pay that in full every single month, plus that minimum payment. So that gets to be stressful. And that is why this payment is so large, okay? So we've got American Express, 32,000 is the balance. Again, 25,000 is that pay over time bucket. She's paying about 8,300 a month on that. The interest is at 27%. It would take 4.5 years and $18,040 to take care of it. Now, though that's calculated a little differently. We'll get into that later. Citi is another card she has at 8,881. And I should say it's not just her, but she was the one that started with all these debts and was concerned about it, in going through school. So I apologize. It is a couple. Okay. So 8,881, the payment on that is 282. It is at a 28% interest rate. It would take 4 years and 10 months to take care of it. They would spend $7,348 to do so. That is the interest debt. Citizens, $5,624, 158 is the payment, 22% interest rate, 4 years, 11 months, $3,570 to take care of that in interest debt. Then we've got Synchrony, $24.95, $92 a month, 34% interest rate on Synchrony, 4.5 years, $2,321 to pay that back. Then we have a truck. Pardon me, guys. Then we have a truck. It's 8,140 is the balance. 283 is the payment on that. 3.21% for 2 years left on it at 329. Now, these are the years that are left, okay, on these loans. We've got an SUV for $16,299. 357 is our payment. 5.8%. 4 years, it would take us, it would cost us $2,130 to pay that back to complete that out. We've got Prosper here. 2,000, I'm not even sure what that is. I'm assuming a vehicle. I don't really know. I guess I'll have to ask. Okay, anyway, $2,893 is the balance. $129 a month. It's at 10.5%. 2 years on that. $340 $342 in interest to pay that off. Now, or pay that back. Lending Club at $5,858. Not 100% sure what that is. If anybody knows, put it in the comments below. I'm curious. I have no idea. $130 payment, 7.3% interest rate, 4 years to pay that back, $993. So under our debt column, we're at $35,071 in interest debt, okay? Now, our total debt is 82,000, sorry, it's kind of off here, 82,190. This is not a part of that debt, okay? So that is not, just so you know, 82,190. And our monthly payments are $10,657 on just the debts, okay? Just the debts alone. All right, so what we have going on here is a whole heck of a lot, right? Now, luckily for them, and they did not know this until, contacting us and talking through us, that there were home equity lines of credit that could help them, okay? And of course, as soon as you start talking about home equity loans, okay, or lines of credit, we talk about home equity lines, but banks will talk to you about home equity loans, and they will be steering you towards a home equity loan all day long. But they were able to go to their bank, and it is a credit union, and discuss with their credit union what they want to do with it, okay? And it looks like they're qualifying at this point for, okay, $70,000 in a HELOC, and there is an introductory rate of 1.99 for, I think, 6 months, and then it goes to another percentage. So I'm just going to say 9.9%. Okay, we're going to average it out a little bit. So we're going to say, and this is high because they were quoted even lower than that after the 6 months at 1.99. But I'm going to say at 9.9, maybe 10%, whatever, close enough, right? Let's go with 9.9%, and we're going to see what happens when we work this through Velocity Banking, using a home equity line of credit to work down debt that she never thought she'd be out of, at least not for years upon years upon years, okay? And she still will have student loans to pay, okay? So those are coming up, but she is now going to learn, or she has now learned to do it a different way, right? She's going to do it a different way. Now, so what are we paying? And my hint here are the check marks, right? So here's what we've done. We've taken a look at this, and now, again, you guys, there's always other ways to skin a cat. So if you see an even better way to do it, hit me up, let me know. I'll be happy to entertain that, okay? So we're going to pay the American Express, the City, the Citizens, the Synchrony. We're going to take care of this SUV, and we're going to take care of the Prosper. Now, sometimes in looking at the loans you've already paid interest on, you go after the interest rate versus the payment sometimes, but usually it ends up being that if they have a higher payment, you're still taking care of those payments, and they usually lead to the ones that you still have more interest to pay later, okay? So this is what we're doing. We are going to take care of these 4, so 6 out of the, 8? No, well, 9-ish, but we're not really including this because that's a whole different animal, okay? So out of these 8, we're taking care of 6, okay? So we're going to take care of 6 of these, and we're going to do it in one fell swoop, all right? So I am about to clear my board for you, and I want to show you what the total is on that and how we lead this, okay? So how we lead it and where we're going with it. Okay, so give me just a second. I'm going to clear this for you, and we are about to work down a pretty incredible situation here. Okay, so I'm back with these numbers on the board here, and I want to show you how incredible a line of credit, especially a home equity line of credit, can help you work down debt. Now remember, these lines of credit, what make them so unbelievably important and special to us is that they are calculated on an average daily balance. So why is that important? Okay, number one, it is average daily balance is important, and number two, the fact that they revolve, meaning you can put your income in and you can run your expenses out. Income in, expenses out. So what does that do for us? Well, it drops our interest rate dramatically, especially when in this situation you can see I start at $68,192 and I'm dropping it by $17,200, which is my income or their income. Okay. So their combined income, which means they have dropped this initial balance from $68,192 down to $50,992. Okay. So when they do that, what happens? Well, you immediately go from 68,000 down to 50, which means the interest that you would be charged is going to drop dramatically as well. Now, the interest is not going to be calculated at 68,192, even though that was the beginning balance that we had. Nor is it going to be calculated on the 50,992. It will be calculated on an average, okay, the average daily balance, because every day that goes by, that card is going to be at a different rate. They're averaging it, okay? And it's that average that allows us to have a lower interest rate. And as we run our income in and run our expenses out every month, it is going to drop for us. And you can see that illustrated quite well here with 491, 421, and 351, right? So that's the interest. So I color coordinate it for you. This is my starting balance. The purple is my income. The blue are my the expenses that are coming out of my line of credit every month. And the green here is the interest that line of credit that I'm spending to use that line of credit. Okay, so it's the interest that I'm spending. Now, how does this work? This is how it works. You have a checking account. Everybody has a checking account. You know how those work. When you have a line of credit, whether it's a personal line of credit or a home equity line of credit or a business line of credit, they are attached or should be attached to your checking account. If you do not have a way to get a line of credit that's attached to a checking account, keep shopping because it won't help you. All right. It won't help you as much. It'll help you some, but not in the way that we do this. This is the important part, that it is connected to that checking account, a way to pay for your charges. Okay. So it's connected. A personal line of credit or home equity line of credit is connected to that checking account. So as you need funds to pay your monthly expenses, right, it's going to be drafted from that line of credit. It'll go into the checking account. From the checking, you then spend your money monthly, okay, for your bills, your groceries, your utilities, whatever you're spending, okay, monthly. It comes right out of that checking account, but it's sweeping from that line of credit, okay? And then every month, you're going to put your income right back into it, okay? So that's what is illustrated here. Your balance, your income drops it to the low for that month. Your expenses come back out. In this case, are $82.64 plus the interest to borrow that money, right, is $491, brings you back to $59,747. Now, $59,747, here's where we do our checks, right? In math, you guys always do checks, or you should. So here, $59,747, is that less than or greater than what we started with, the $68,192? Well, it's less than. We're working okay right now. Let's roll into month 2 and see what that looks like. So we start with the $59,747. Our income comes in. It drops our balance to $42,547. Our expenses come back out, which is the $82.64, plus the interest, which is lower again this month, right? Because our balance is moving down. And that takes us back up to $51,232. Now, is $51,232 greater or less than $59,747? Well, it's less than. Looks like it's working for us pretty well, and it's working for her pretty well in this case, right? Okay, so let me just then look at this and say, okay, so Jen, where did you get the $82.64? Okay, when we started off with the total expenses of $17,582, where are we getting the $82.64? Well, remember, when we paid these off, okay, we paid this off, 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 we paid this off. So that means we no longer owe these, right? So this we don't owe anymore, 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 and we don't owe this anymore. Okay, so we don't owe these. All right, so all of these then come off of our total expenses. So you take your total expenses, which is the $17,582, You're subtracting out your 8,300, your 282, your 158, your 92, your 357, your 129. Okay, you're subtracting out all of those. But wait a second, Jen. I understand you're subtracting out all of those, but what about the payment for that home equity line of credit? What's the payment on that? There is none. And why is there not a payment? Because when your income of 17,200 goes into that line of credit, it becomes the payment. Okay? So it satisfies the need for a payment and it makes that payment of 17,200. Now, this line of credit is never going to have a payment that's $17,000 a month. It's not even going to be close, okay? If it's at 9.9%, it's going to be at worst interest plus 1%, at the very worst. Most of the time, home equity lines of credit are interest only, okay? So you have options and they're never going to be anywhere near what you were paying before, okay? So as your income goes into that line, it becomes the payment and you know you don't have a payment for that line of credit. That is the power of Velocity Banking. That is what makes these lines of credit so incredible to us because we're getting back that payment through our income going in, all right? So we go ahead and we run this. Now, so that's where I'm getting my 8264 by subtracting off all of these payments here. We know where I'm getting my interest from here, right, for my home equity line of credit, but how do I calculate that? So I'm going to bore all of you that already know how to do this one more time, okay? And we're going to look at that. So let's take and learn the calculation for finding the interest each month, okay? You take your high balance, you're going to add it to your low balance. You take that number and divide it by 2 to get your average. That number then you're going to multiply by your interest rate, okay? Then you're going to take that, which is an annual interest rate, and you're going to divide it by 12 to get your monthly interest rate. So let's do that, okay? So if we take 68,192 and we add 50,992, that's going to equal 119,184, I believe. Yes. And then I'm going to divide that by 2 to give me 59,592. Okay, so that's the average. Now, 59,592, I am then going to multiply by my interest rate. And at this, in this example, I'm taking 9.9%. So I'm going to then multiply it by 0.099, okay, or 9.9%, which gives me 58.99, okay, and then I'm going to divide that by 12, which gives me 491, okay, again, 491. So that is how you're going to calculate it each month. And then your same thing over here. You know, you're taking your high balance, you're adding your low balance to that, you're dividing it by 2, you're going to multiply it by your interest rate, divide that by 12, you're doing it month over month over month. So how long does it take this wonderful couple to get out of the majority of this debt, right? Because they still have this truck payment left and this lending club thing going on, all right? So it takes them, and this probably won't surprise a lot of you because that is a heck of a nice income, but it takes them 5 months, okay? 5 months. Think about that, you guys. It takes them 5 months and $1,889 in interest. That's it. That's all. So for her, having this home equity line of credit has been key to them surviving what they're going through, okay? Because they now know how they're going to take care of these loans once they are not deferred and they end up having to pay for her student loans. They know how they're going to attack these loans. They're going to do chunk down payments on the loans, okay? Just like basically, it's just like the mortgage examples that I show you guys. When I show you how to chunk down your mortgage, it's going to be the same thing, okay? They're going to make chunk payments and they're going to work them lickety split because of that income. I mean, check it out. If you're working down $68,000 in 5 months, holy Moses, just think about all the stuff that you can get accomplished with that, what other loans you could, all right? So this is a great example. And I know, I get it, you guys. This is an income we don't see very often, right? And a lot of us are not, sitting there with an income like that. But this is amazing for them. And it changes their whole outcome. It changes their future. It changes so much for them just by knowing there is a way out. And it is simple. It's not difficult. So you guys, pay down that ignorance tax, okay? Proof promise plan. I prove to you today that you can pay this off much faster than you would in a traditional banking system. The promise I have made to you is that you can do this and that you will learn velocity banking. You've already learned something today that you didn't know before, okay? And I know that you guys can do this. The plan is now for you to go out and accomplish your velocity banking strategy. Start looking at more videos, pay down that ignorance tax, right? Ignorance just meaning you don't know something. Pay down that ignorance tax by watching more videos and learning how to do velocity banking. It'll change your life. I know it will. It changed mine, changed Dan's. We now live in a totally different situation than we ever have before. Now, if you guys want extra help, if you would like a plan, if you need help, some extra help beside the videos, you can always email us at info@paydowndebtsolutions.com. If you guys want to leave us comments, we are always in the chat. We are trying to catch up with those comments and answer them back as much as we can. Sometimes we may, if you have a situation with those comments where they're a little more complex than we can get done there, we'll ask you to email us so we can help you with that a little bit more. Have a great day, you guys, and I hope I will see you in the next video.